So, hello everybody. Apologies for the delay. We had a slight issue with Zoom, not from our side, where we couldn't seem to admit people. So, I'm going to wait a minute while participants are admitted. But thank you for your patience. And we may end just slightly later than we anticipated. This presentation is due to go on till 12 o'clock. I'll take two screen breaks a little bit later than I anticipated, and let the show begin. As I say, please use the chat box, or if you have any questions, or you can use the Q&A box as well. Q&A box is probably preferred. And on that basis, there will also be the slides will be in the chat box in a PDF. Anyway, without any further ado, welcome to this Accentuate by K3 Hub year-end tax planning. My name is Jeremy Mindell, and I'm doing this session on year-end tax planning. Really more looking at the tax year-end, but it is actually quite useful to do it now before the year-end, which for many clients is their accounting year-end, but also in the light of the budget. And also, before the end of the tax filing season for 24-25. I got a few, obviously, there are some comments from the budget, but it's not dominated by that. But I thought I should set the scene, at least at the beginning, which is that the budget certainly is increasing taxation. And the issue there is it's the freezing of the allowances. Allowances will have been frozen for about a decade by the time we come to the end of this in 2030-31. And what you can see here is that more taxpayers will be dragged in to paying income tax because their earnings will exceed the personal allowance of 12,570. And also more taxpayers will be into the higher rate of tax at 5270. And then also, although it's less, there will be more taxpayers who will be in the additional rate, which is at 125,140 pounds. Now, the interesting point is that by that point, as I said, for a decade or so, there will have been no rise in the personal allowance and the high rate tax band. And indeed, for the additional rate tax band, it will be 20 years since it was introduced. At that point, it was at £150,000, and then it was reduced to £125,140 a couple of years ago by Jeremy Hunt, and that is due to be frozen until 2030-31. So far in this Parliament, we've seen this is the largest tax rises in any Parliament, and we've only had two budgets since 1970. So the IFS has gone back to 1970. The bar charts in blue are the Conservatives, the ones in red are Labour. The shaded yellow and blue one is the Conservative Liberal Democrat coalition from 2010-2015. And what you can see is that already we are at the largest tax rises as a proportion of GDP since at least the 1960s on that basis. Let me have a look at the chat. The questions, Q&A. Slides. Okay. There's no real questions for me. Okay. Yeah, as I said, there was a Zoom outage, and that obviously delayed matters on that basis. Anyway, let me carry on for a bit and then I'll take a few more Q and A's. One of the elements that is somewhat concerning and must be concerning from the point of view of tax planning is very much that it's a spending soon and tax later type budget. In other words, a lot of the decisions in terms of the extra taxes, as you'll see, are effectively end loaded towards the end of this parliament and beyond. So what you can see here is that their tax rises all the way to 2030, 31. That is 2 years beyond the last date for the general election. And what you can see here is that spending goes up, but tax only catches up later. And there is some question mark about the credibility of a government raising substantial amounts of tax in the run up to a general election. And the question is going to be is how credible is this? And that may mean that there may be more tax rises, different tax rises, particularly if there is any change in terms of the personnel at the top of the government, even if there isn't a change of party before any general election. And I put this slide up in terms of tax planning because I think that the position, although unusually for a budget, we didn't just get tax rises announced for this year, the budget day, and also for the next tax year, we got tax rises announced for the next 4 or 5 years. But the question would be is, do they have credibility and how should one treat them? The other element that I would look at is when we're looking at the budget and tax planning, let's look at the dogs that did now bite. What do I mean by that? Is there were tax rises before the October 2024 budget. And of course, we had 40 billion of tax rises then. There were rumors about things that were going to be done that weren't done, right? And therefore, on that basis, some of those surfaced in this budget. So fuel duty not rising in this budget, but actually rising in September 5p. The mansion tax, long anticipated, actually has come about for 2028. Income tax threshold extension of freezes, that was specifically ruled out in the October 2024 budget, but has come into effect or was announced at this budget. Lots of rumors about dividend tax rises in the last budget, but in this budget, they came to fruition with a 2% rise in both the basic rate, so from 8.75% to 10.75%, and also in the higher rate from 33.75% to 35.75%. And I suppose one of the elements you might want to think about on that basis is whether your companies should do that owner-managed businesses and others should think about doing dividends before the end of the tax year rather than into 26, 27. The dividend tax rise, curiously, does not affect additional rate taxpayers. So if everybody is an additional rate taxpayer who's a shareholder, that isn't an issue. But if you've got within a family company lots of people who are basic or high rate taxpayers, it may be worthwhile thinking about a dividend before the end of the tax year. Of course, you do need to have distributable profits on that basis. And with distributable profits, you can then make a legal dividend. Employers NI on company pension contributions. So there was rumours of national insurance on all pension contributions made by the employer. At the moment, there are no national insurance on pension contributions made to a registered pension scheme. However, the limitation comes in from 2029, salary sacrifice at £2,000. And at that point, you have to think to yourself, well, that's nearly 3.5 years out. I could actually do an effective salary sacrifice scheme now, and it could last 3 years. The other element is that I can still stuff money from my OMB into a pension for the next 3 years, and beyond possibly. And there was no effect on the annual allowance. So therefore, on that basis, I could put, probably, if I don't have adjusted gross income above £260,000, I could put 60,000 into a pension direct from the company. Then I have the ISAs. So there are limitations in terms of cash ISAs, and people are looking at this. But in terms of stocks and shares ISAs, there is no further limitation. It's the £20,000. And so therefore, given the fact that both divvy tax has gone up and capital gains tax went up in the previous budget, ISAs look very attractive at the moment on that basis, certainly stocks and shares ISAs by comparison, because suddenly, when it was 12,300 of annual exemption, most people didn't have to worry about capital gains tax. Now, if your shares go up, if you invest in the right ones, £3,000 annual exemption could be easily used up. So that sort of element is something that you would want to think about. Then in terms of the venture capital trust, at the moment for subscriptions into venture capital trusts, we're talking about a 30% reduction in income tax. Whereas after April 2026, we're looking at 20%. And I've already been receiving plenty of offers on that basis. And that's something that I think that we should, that you may want to think about. Again, venture capital trusts do have a particular advantage for high net worth individuals. What is their particular advantage? Well, their advantage is that what you're looking at there is that any dividends paid from a VCT would be effectively tax-free. So if I get a dividend from a VCT, I can, the more I have in terms of VCTs, the more stream of tax-free income. And if I have a dividend reinvestment plan, what is known as a DRIP, a dividend reinvestment plan where my dividends are reinvested in new shares, then I keep on getting tax relief on the dividends. So if, let's say, I have £500 worth of dividends on that basis paid out of the VCT, then I end up with £150 knocked off my tax bill. At the moment, after April, that will go down to 20%, but still valuable on that basis. Let's look at the dogs that did not bite, but as I say, could bite if the Chancellor comes back again. After all, she promised she wasn't going to come back again for big tax rises after last year, but she has done so. So who knows what will happen next year. No change to the 25% pension lump sum tax-free amount. Now, this is one of the areas where tax planning has its costs in terms of people who panicked and took out that money are now sitting with that money in a taxable environment rather than a tax-free environment. They might not need the money at this point. And the other element is it stops them putting more than £10,000 normally into another pension. So this is not necessarily a great element where people have done, but, I can't blame them. It's, in my view, government letting rumours get out of control. And that was referenced in last Prime Minister's question time. Pension annual allowance at 60,000 plus 3 years of unused relief. One at £40,000, two at £60,000. That gives you potentially the ability to put £220,000 into a pension pot and get full tax relief, or £220,000 from your OMB into a pension pot. And we'll talk about that later on. No EIS or SEIS restrictions, enterprise investment scheme. Indeed, you can go further with enterprise investment schemes and get more, you can actually invest more, and the companies, the type of companies and the amounts that they can invest have also grown. So that's part of the growth agenda and was actually very good news in my view. No, lots of rumours about the potentially exempt transfer regime, which has been around since 1986 when inheritance tax replaced capital gains tax. No change on that. Still a 7-year, still with the taper on the tax, not the amount in the estate, but taper on the tax if you survive more than 3 years. Again, a lot of rumours about normal income exemption for IHT on that basis. So normal income exemption for IHT, if I have income of £200,000 and expenses, including tax of £150,000, that £50,000 surplus income I could give away. National insurance on limited liability partnerships. Again, lots of rumours about that, but it didn't happen. And then residential nil rate ban, although it was frozen at £175,000, the nil rate ban for IHT for your residences still remains in place on that basis. Other elements, as I say, making the most of no lifetime allowance. There's no retrospection on that. 220,000 contributions potentially in 1 year. If you've had a pension scheme for the previous 3 years and you've not used up the money and you've not made a contribution, you could, in theory at least, put £220,000 into it. You do need to keep your earnings below £200,000, the income threshold, in order to do that. So I'm going to take something on the chat, hopefully not just about the slides. Okay. Slides are in the chat box. So at this point, can we do the poll about where do you all, what industries are you working in? All right. Vast number in accountancy, some in tax. We've got a little bit in banking, law, and other one, and an entrepreneur as well. Okay. Thank you very much. I think in terms of tax planning, there is something I always say, but I think it's really important when life is so uncertain. The important element is to look at having the right information at the right time and keeping information at your fingertips. So my lodestar in this, my rule of thumb that I always talk about, is keep a track of your wealth, your business, and your finances. So if you talk about an owner manager of a business, it's okay for me to say, perhaps you think about paying a dividend before the end of the tax year, before dividend rates go up. But you do need to know what your distributable profits are, because if you don't know what your distributable profits are, how do you know whether you can make a legal dividend? Something that people seem to ignore quite a bit. The other element is, what about the marginal rates of tax? So, for example, this is a classic example. if you pay me a dividend and it takes me over £100,000, that may not be a great idea, both in terms of the loss of the New Style child support and, of course, the fact of the phase down of the personal allowance. It also, you don't need to rush for a dividend if everybody is an additional rate taxpayer, because the tax rate on dividends for additional rate taxpayers is not going up. So it's always important to look at what is your marginal rate of tax, and not just from the point of view of the individuals, but also in terms of the point of view of the company, on the basis that you could end up with a margin rate of 19% for a company if their profits below at or below £50,000, or to 25% if they're above £250,000. But there is a marginal rate which erodes your small profits relief between £50,000 and £250,000 of 26.5%. And of course, that can make all the difference. So it's information, getting a picture of what your wealth is, what you intend to do with the money, what your long-term horizons are. When you're looking to retire, when you're looking to buy a house, what about the children and the education and grandchildren and so on. So always important to look at those particular issues, because then that gives you the tools to act or react quickly on that basis. And information is key. Whenever there is uncertainty, hasty action may not work. For example, like, taking out your pension. If that's not within what you want to do or what don't want to do in the near future. And I always say with tax planning, it's fine to bring forward something that you plan to do in the next year or two. It's ludicrous to do something that you weren't planning to do for the next 5-6 years. For example, we've got a general election which is due in 3 years' time. So if you're looking at IHT, why are you worried about it if you're not looking to make dispositions in the next 3 years? So that's an important aspect that you need to think about quite carefully on that basis. Bringing forward your pension by 6 months, 12 months doesn't sound a bad idea. Bringing forward it by 5-6 years is another matter. Selling your business because you're intending to sell it this year or next, bringing that forward is probably not a terrible idea. Panic selling probably will cost you more in terms of the price of the business than the actual tax saving. That was certainly the experience last year, when there was a huge wave of people trying to sell their businesses before Rachel Reeves' rumoured increases in capital gains tax, which only ended up being effectively 4%. I suspect most business owners lost more because actually they sold for less in order to get it done before the 30th of October. It is at the moment, as something that was said by speakers from Consumer last week, it is very much a buyer's market, and you need to think about the commercial aspects if you are a seller. So let's look a little bit more at the tax planning, always helpful. One of the elements would be is obviously the personal allowance, use it or lose it. You can't take it forward, you can't carry it back. You can, if one person doesn't use it and the husband or wife is a basic rate taxpayer, then you can transfer 10% of it to your spouse, worth £252 a year. But apart from that, it is a use it or lose it. But again, in terms of paying members of the family, there needs to be a salary justification. You might start with the national living wage that's going up, and that would help with it. Can other people hear me? Somebody has said that they've lost sound. All good. Okay, so I'm assuming then if one person's lost sound, then it's probably communication on their side. It has been slightly a frantic day in terms of Zoom outage, not our outage, and so there may be some issues to come on that basis. So, but thank you on that basis for your patience. Okay. Um, Other exemptions on a use it or lose it basis. So capital gains tax, the miserable £3,000 that we're getting. I mean, that is lower than it was in the 1990s and late 1980s. I mean, astonishingly low. Um, and that isn't Rachel Reeves and Jeremy Hunt did that. But still worth using. So thinking about bed and breakfasting, buying and selling shares, sorry, selling and then buying shares before the tax year end, or bed and ISA, where you don't have to wait the 30 days before rebuying the shares, or bed and spouse, you sell the shares and the spouse buys them to keep you in the market if that's what you want to do. IHT, £3,000, either in terms of a capital gift or in terms of the what you would be looking at there is maybe 2 years if you haven't used the exemption last year. Of course, you've got the normal expenditure out of income. And again, a great point of starting that is when you do the tax return, um, you should get a good idea of a client's income and expenditure. And then it's only one further a step to complete the spreadsheet to see whether they've got surplus income they could give away if they wish to do so. Personal savings allowance, £1,000 for basic rate taxpayers, £500 for high rate taxpayers. Savings allowance, £5,000. So if you keep your salary as an OMB at 12,570 or below, and maybe only £500 of dividends, then you can put £5,000 savings from a director's loan account in credit. Enterprise Investment Scheme, £2 million, SEIS, 200,000, and VCT, as I talked about, 200,000. Last orders at 30% relief. Corporate review OMB. So if you've got an owner managed business, what you should be looking at is the employment allowance qualification. Who pays? Is it enough? Have you got two people subject to national insurance? Remember that the employment allowance is an allowance against secondary NI, which went up to £10,500. So that, in my view, is something important, very valuable. You don't have to worry about whether you pay £100,000 in secondary NI the year before. So the employment allowance, very useful. You've got to watch for associated companies because you only get one per associated groups of companies, but still very valuable on that basis. And that also, to a certain extent, changes your salary dividend analysis on that basis. Um, Transfer pricing. So that is for larger companies, but review charges in year to avoid one-way street trap. In other words, HMRC allowing you to adjust to increase your income subject to tax, but not to adjust it downwards. If another country charges more, the UK won't necessarily allow you a corresponding adjustment. The element with that is that you can make the adjustments before you file the accounts. You're in difficulties afterwards, and people might say, well, transfer pricing, that's for large companies, but do think about profit fragmentation. Very similar rules put in 2019 which affect smaller companies, partnerships, and all sorts of other interests on that basis. Think about the distributable reserves that I talked about, because if you're looking to pay dividends, you've got to have the distributable reserves. And also surplus capital. If you have surplus capital, what counts as an excluded asset. Then there's also business asset disposal relief and investors relief. Business asset disposal relief is where you're involved in the company and you've got a 5% shareholding individually. And it's a trading company. And investors relief is where you subscribe for unquoted shares and you don't have a connection to the company. Last orders are for the 14% rate. So that gives you an effective 10% saving on the CGT rate of 24%. So that is worth up to £100,000 this year if you make the sale this year. Next year, it goes down to 18%, or rather, the rate of tax goes up to 18%, and the saving goes down to £60,000. So for a husband and wife OMB combo, that's the difference between £200,000 saving and £120,000 saving. And the same is true for investors relief, where you had to own the shares for at least 3 years. If we look at the remuneration route, salary, bonus, director's fee is more clunky, as you've got certain compliance hoops, pay as you earn, RTI being the obvious one. But you do need to think about that quite carefully. And whereas dividends used to be almost always more tax efficient, that is not the case now. The upside of salary is that the corporate deduction will be available, providing the payment is made for the purposes of the business and is reasonably commensurate with the duties performed. If we look at the dividend route on the other hand is much simpler to put in place and can be made without worrying about pay-as-you-earn obligations or NIC, but there's no corresponding corporate tax deduction. The recipient does, of course, need to have shares in order to provide the conduit through which to pay the dividend. It used to be really attractive. Back in 2016, we had a dividend nil rate band of £5,000, which was supposed to then mean that 80% of divs were not subject to tax. That has been reduced by 90% to £500. The point would still be that, let's say you paid a child of yours had shares in your company, and if they're over 18, they can use their personal allowance and against the divvies, because it would be their taxable income. You don't have the settlement provisions then. So you could pay a dividend of 13,070, could be paid tax-free, as this will utilize both the personal allowance and the dividend allowance on that basis. But again, you've got to look at what other income they have. So dividends could be paid so as to utilize not only the personal allowance and dividend allowance, but also the basic rate band within which dividends are charged at the still generous rate of 8.75% for this year, up to 10.75% in April 2026. For a family member with no income, a dividend this year of 5270 has a tax cost of around £3,255, an effective rate of just north of 6.47%. Even with the increase from April, 10.75%, it's still a very attractive rate of tax. Other elements you'd look at: if there is a family trust in existence, conversations should be had with the trustees with a view to making income distributions to beneficiaries who do not use their personal allowances. Minor children are the obvious weapon of choice on there. If the trust has not been settled by a still living parent, if the trust has been, say, set up by grandparents for the benefit of the grandchildren, then you get this big advantage. Well, you get two advantages. One is the tax, the other is the asset protection. And a lot of grandparents set up trusts to ensure that if there is a divorce, that the money doesn't go away with the departing spouse, but goes to your grandchildren. So you do it for the use of school fees and so on. For discretionary trust, this generally means that payments of around 6,900 can be made to the child with the associated 45% tax credit, 5,600 or so repaid later by HMRC. The one element that you need to think about is where is the source of the income. If you just use the grandchildren, the grandparents as a conduit, and the money came from the parents and the children are under 18, then the settlement rules would apply. In the chat box, more about the slides. No questions for me. No. Okay. In terms of larger earnings, it's important to think about, in terms of persons earning over £260,000, 25, 26, they will want to make a projection regarding their earnings and therefore the amount of annual allowance left to them. Remember, the phase down works that for every £2 of income above 260,000, one loses £1 of annual allowance until you reach 360,000, when one reaches the floor of £10,000 contributions. For example, if an individual has adjusted gross income of 280,000, the adjusted gross income is therefore 20,000 beyond the threshold, and therefore the annual allowance will go down to £50,000 on that basis. Obviously, in terms of pensions, the challenge is how much to pay this year, how much carry forward, the AGI phase down, how much personal and how much from the company, and also bank transfers. How much should you give personally? That would reduce your taxable income, and it's now one of the few ways to reduce your taxable income. And on that basis, you might think if you've got a high marginal rate, 45% or 60% in the bit between 100,000, 125,000, 140, or indeed at the 60 to 80,000 child benefit phase down, you might want to make some personal contributions, but otherwise maybe from your OMB and also bank transfers on that basis. As I say, in avoiding losing the personal allowance, what you're looking at is that band of 100,000 to 125, 140. It's very interesting. The press rediscover it every year, but it's been a feature of the system for now 15 years. And you've got to look at the spouse, the charity, the pension, or always possibilities. So getting the spouse working in the business, and he or she may be a director or company secretary as well. That would then justify the payments being made. Payments to charity, that's one of the few areas where you can actually carry back a year and get a deduction against taxable income. Remember, SEIS and EIS are deductions against the tax. They reduce the tax. They don't reduce your taxable income, so they're not helpful in terms of actually reducing your marginal rate of tax. They are reduce your tax you pay, not the taxable income. Pension does, but you can't carry it back a year. So you've got unused relief that you can use this year, but you can't carry back the pension contribution. The only thing you can carry back on this list is charity. Income deferral, you might decide, again, you need all the information to look at income deferral. And of course, salary sacrifice, still available for different elements, including pension. And that pension element is still available for the next 3.5 years or so. As I talked about, transfer of personal allowance, 10% of personal allowance to a basic rate taxpayer, who is your spouse or civil partner, worth £252. And if you haven't claimed it for the past 4 years and you were able to, that's a nice £1,000 bonus from HMRC. The same tactics would apply in terms of the 60 to 80K in terms of the child benefit, similar tactics to personal allowance abatement. This is the festive period, trivial benefits up to £50 for entertaining staff, or the annual dinner up to 150 quid. The element you always need to think about there is all the incidentals with your, if you've got an overnight stay with your Christmas party, that overnight stay needs to be included, and that could easily take you over £150 a person. Charitable contributions. So you could carry back 1 year to 24-25 if you make the contribution before you file your tax return or the 31st of January 2026. So that's the last date for filing your tax return. And if you file it on that date, then you could carry back all the contributions made up to that date. If you're late with your tax return, it's only up to 31st of Jan 2026. Or you could use them in the current year. And that's where looking at what your comparative tax position is going to be so important. In terms of an ISA, 20,000, use it or lose it on that basis. On that basis, use it or lose it. And it's still around. I consider it the onshore tax haven. Let's take the fact that if somebody has subscribed for them since they were first introduced by John Major as Peps and Tessers when he was Chancellor in the early 1990s, if you've reinvested that money, it's quite possible that you would be an ISA millionaire by now. What does that mean? Well, let's say you get a 5% yield on £1 million, that's £50,000 completely tax free, and you don't even need to put it on your tax return. And even better, another opportunity with that is, let's say, a married couple or civil partnership, one person dies, then the other person inherits that allowance in terms of the full amount of the ISA can be transferred. And on that basis, let's say I had £1 million and my wife had £1 million, and if I die, she can then put that £1 million into an ISA that year. She ends up with £2 million, and therefore £100,000 potentially at a 5% yield coming out completely tax-free basis. And then you've got the junior ISA at £9,000. These are all being frozen, I think, till 2031. But even on that basis, a family of 5, husband, wife, and 3 children below the age of 18, we're looking at somewhere in the order of £67,000 could be swindled away in tax-free amounts. Then there are the share incentive plans. So partnership shares, where somebody buys it in the company and gets tax and NI relief, £1,800, £3,600 of matching shares can be given in exchange for the partnership. When you do the partnership shares, you can then match on a tax-free basis in the company. 3,600 of free shares, plus any shares which are any amounts which are reinvested in new shares. They would be dividend shares, and again, potentially tax-free. The important element with this, which I think is overlooked, is IHT planning for the family business if and when this BPR restriction comes in. SIP shares can be given in a wide variety of companies, and when you look at the discounts for unquoted trading companies, this could be very useful not only for income tax and capital gains tax treatment, because once in the SIP trust, those shares are capital gains tax free, and also until they leave the SIP trust, and then you get the step up to the value when they leave the trust. But also on that basis, what you're looking at is here it is also that if members of the family actually work in the business, then they're getting the shares by reason of employment, and therefore there's not an element of bounty, and therefore no IHT propose on it. So I always think that share schemes should be looked at not just in terms of capital gains tax and income tax, but also now in terms of inheritance tax planning as well. Then we come to MTD, making tax difficult. Things to remember about MTD, well, it's coming in April 2026. There are lots of webinars about that, some of them by the Caring Sharing HMRC. And important to understand that this is a big departure. So at the moment, you just have MTD if you're VAT registered, whether compulsorily or voluntarily. Now you're going to get MTD for income tax. And what are we looking at? If you receive qualifying income from self-employment and or property, you'll be legally required to use Making Tax Digital for income tax based on the level of qualifying income from the following dates. April 2026, if your qualifying income is over £50,000 in 24-25. April 2027, if your qualifying income is over 30,000 in the 25 to 26 tax year. And April 2028, if your qualifying income is over 20,000 in that year. And what you're looking at there is obviously expanding the net every year. In terms of a business, what you need to think about is that there are live webinars that they do on this sort of thing, and about the requirements for MTD for income tax, the practical steps, the rules, making informed software choices. So HMRC has a list of approved software for making tax digital, I should say, and maybe authorizing your agent if applicable and signing up to MTD and utilizing any benefits or opportunities. So the element there is getting you up to date, that every quarter you need to think about your accounts, your income, your expenses on that basis, and submit quarterly reports under MTD. There's no tax as yet compulsorily paid on that basis, although I don't think it'll be long before suddenly HMRC will be looking for quarterly instalment payments based on your MTD. My view is that there is a lot of weeping and wailing about it at the moment. And mine is a somewhat controversial view, is that it's a bit like taking medicine. It may not taste very nice, but actually, ultimately, you may get a better handle on your business. When we talk about tax planning before, I mean, I always do half-year accounts in order to look at what should I do before the budget. How do I know how to plan if I'm not keeping a grip on what my income and expenses are on my business? You know, looking at any unpaid debts, unpaid creditors, the margins, and so on. A quarterly review of a business is not actually a bad idea, both from a commercial point of view and, of course, a tax point of view on that basis. And the same is true if you're sole trader or landlord without an accountant or bookkeeper. You can register for a webinar on that basis. And they look at the planning, how to prepare, the actions you'll take, and using MTD for income tax. And my view would be, is obviously that is HMRC's view about it, but the idea is to inform. But the first element is the record keeping, and the second element is going to be the accounting, which you may want to do now on a fully digital basis. Which sort of leads me on to the fact that at least you should be thinking about for your clients, do they do half-year accounts? After all, if you think about pension phase down, if you think about the marginal rates of corporation tax, if you think about elements of benefits and expenses, half year, a snapshot at half year to look at things like distributable profits and marginal rates is, of course, extremely important. And in terms of looking forward, looking at your income, expenses, projections going forward, your plans, business plans, and your cash flow on that basis. Okay, we're at 3 minutes past 10. Let's take a 10-minute coffee break now. So a 10-minute coffee break. Okay, any questions? So I did have one. Is it correct that the pension annual allowance clawback is only applicable if the two test, if the threshold income, which is at 200,000, and the 260,000 adjusted gross income, which includes pension contributions, is breached? That is true. So you could have threshold income below 200,000, and even if the AGI is really high because you've made a lot of pension contributions, that would be okay. The phase down is not triggered at all if your threshold income, which excludes pension, is below 200,000, is at 200,000 or below. In terms of, let me carry on. In terms of getting the tax return done early, we're a bit late for this year, but it's something certainly to remind clients. There is obviously less time to lose documents, easier to remember expenses on that basis, and the whole process should be quicker and more efficient on that basis. So always important to think about that. But even if you don't get the tax return, even if you got the tax return done now, what you would be looking at is, let me have a look at if there are any other questions. Nope. So I've got a question from Steve. Does MTD apply if you're completing the tax return as an attorney? Well, MTD applies based on the client's turnover, not and it would be separate for you if you're an attorney earning more than £50,000, then it would be for you. But it's not a question of, if you complete the tax return, you have to do the MTD for the client. The client can do the MTD themselves. It doesn't have to be you doing it. And therefore, the tax return preparation and the MTD work are separate and don't have to be done by the same person. If you do your tax return relatively quickly, obviously there's more time to plan 25, 26 because you'll gives you a better snapshot, a great base for what you do. I did an article in Taxation beginning of the year about using your tax return as the basis for tax planning. Consider difficult issues. So where you've got a real technical issue. I remember I had one on crypto assets I needed to get advice on. Check the accuracy of third-party information, plan any tax payments that needs to be made, and make elections. So, for example, what you don't want is, let's say you need to make an election by the 31st of January. There are quite a few. Might be to opt out of the pre-owned assets tax or other elements that you'd be thinking about. A lot of elections are due by the 31st of January. In terms of planning payments, what you could be looking at in terms of planning payments would be, well, you've got this bill coming on the 31st of January, comes each year, making sure you've got the funds available well in good time for that payment. ISAs, many taxpayers leave it to the end of the tax year to make ISA investments. Obviously, making them early in the year increases the opportunity to earn more dividends tax-free and also to enjoy tax-free appreciation on that basis. In terms of pensions, again, the longer that the funds are in pension schemes, the more they benefit from tax-free growth on that basis. I don't know why it's gone wrong. Um, so the element there is the longer the funds are in the pension schemes, the more they benefit from tax-free growth. Typically, two dividends in a tax year. The annual allowance, which is the deductible against your highest rate of tax, and the unused relief is up to £160,000 this year on that basis from the 3 previous years. May say a different figure, 180,000, that would apply to the next year if you put it on PDF. So it is 160,000, which is two lots of 60 and one lot of 40. In terms of persons earning over to 260,000 for 25-26, they'll want projection regarding their earnings and therefore the amount of annual allowance left to them on that basis, as we discussed before. But that's a reason, again, in terms of projections that you would want to do. Q&A. You mentioned to give shares to children A and B. What are the IHT implications if it's gifted to minor children, adult children working in the company? Will they not be caught by ERS legislation? Thank you for the question. Well, let's try and unwrap this. Let's have a look at, let's assume a few questions. Is it a trading company or is it an investment company? With a trading company and it's unquoted, you will probably get business property relief. So it depends, in terms of the limitation, how much of the 1 million relief will you have used? Remember, there are anti-forestalling elements in terms of the position pre-April 2026. Second element is if I'm doing the gift and these children don't work in the company, then there's an IHT element. They do work in the company, then they may be employment-related securities, and that's the question of where I start thinking about using SIP shares or options or something like that to reduce and mitigate any income tax charge. The element in terms of minor children, obviously they're probably not working in the business. Dividends would be ineffective because they would still be taxable income of yours. Whereas for adult children, they will not, any dividends will be their tax liability. So even just in the terms of giving shares to adult children, there is an advantage in terms of the dividends. The other element to consider is maybe you do different classes of shares, some of which class of ordinary shares, some of which pay dividends, some of which only pay dividends when the children become adults. But the point I would make there is that the advantage of giving shares early is that obviously if the business is growing, the value of shares you are giving is less. And I wouldn't be so worried about IHT because even if you don't get BPR in full, which you probably would for most businesses, where you're giving small packets of shares, the issue would be capital gains tax in terms of the disposal of shares where the gain is more than £3,000. So there's more of an issue, in my view, in terms of capital gains tax, although then you're into the questions of holdover relief, and that becomes more complex on that basis. Holdover relief being available for trading shares rather than investment shares. So I hope quite a long answer to something that is quite a big area on that basis. With capital gains, obviously, if you're at the start of the tax year, there's a greater opportunity for planning in terms of making disposals of assets, particularly ones that are less liquid. Consideration needs to be given to the applicability of business asset disposal relief and whether the proceeds are going to be reinvested in a tax efficient format, giving you potentially rollover relief or deferral tax, or are they just going to be used for personal purposes, in which case there's no deferral of CGT generally. Yep. So pension strategies in the last 6 months of the year. What we're looking at there would be the non-changes in the budget. And the changes as well. Lifetime allowance was abolished by Jeremy Hunt and not resuscitated. I think the reason for that was there would have been too much problems with hospital consultants not taking on shifts in the NHS if they had brought back the lifetime allowance. It's always interesting when we get principles. So you get some pointy head in some um, some think tank who says, "Oh, it's not fair that the most well-off people get the most benefit out of pension relief." Then they go and try and limit it, and then find that there aren't consultants to staff the NHS for the last few months of the year because they say, "Well, the pension position is so penal to us, it's not worth taking on extra shifts," which is the reason why they decided that the lifetime allowance. So Jeremy Hunt abolished the lifetime allowance, and the Labour Party originally was going to bring it back, but decided that this would cause too much problems with the NHS. Cap on tax-free amounts remains at 25% of 107,300. So that's £268,275 tax-free. Do you build up your pot? Do you go big on salary sacrifice before 2029 on that basis? So the framework from April 2024 is no lifetime allowance, but death benefit allowance and default lump sum at 107,300, as we talked about. Lifetime allowance protection protects higher tax-free cash sums. So if you made an election beforehand for a higher limit like 1.8 million, you're in a better position in terms of the cash tax-free lump sum. And the framework from April 2024 was that the income tax exemption on amounts if the person dies before 75 and the IHT advantages remain. The changes from April 2027 means that die before 75, you're still going to have IHT on the pot, and die after 75, you'll have income tax and IHT on the pot, which could lead to a tax charge of over 80% on that basis. So the position will be unused pension at death. Before 75, IHT will be from 2027, income tax free. 75 plus IHT and income tax at the marginal rate for the beneficiary. In terms of the pension contributions, I've talked about the 25, 26. So 60,000, 24, 25, 60,000, 2 years unused relief. So 2023, 24, 2023, 24, 60,000, 22, 23, 40,000. That's where you get your 100,000 for. So that's where you get your 220,000. In terms of the phase down, again, as I pointed out before, the income threshold, 200,000, the AGI threshold, the difference is there you take into account pensions, is 260,000. In order to get to the phase down, you have to exceed both of them. And that the income threshold is particularly useful where you're looking at catch-up pension contribution. In terms of company versus personal contribution, and again, this is where tax planning and, if you like, knowing your position comes in. So, company marginal rate, you make a saving at 25, 26.5 or 19%, as I talked about, and a national insurance saving on that basis which was something that the government was eyeing up. If you make a personal contribution, marginal rate again, there could be 20, 40, 45, or 60% plus. If you have enough children with child benefit between 60 and 80,000, you can end up with a higher than 60% marginal rate. But there's no NI saving on that. So you're taking it out of money that has been subject to probably employer and employee NIC, and you don't get that back, nor does your employer. One of the elements that people think about is smart pensions, and they should still work for the next 3.5 years. You save 15% NI, that is NI, and save 8% primary NI. The budget change was 2K limit on salary sacrifice national insurance free, and that was coming in from April 2029. The element that's interesting is if you have a 31st of March year end in your company, which a lot of people do you make the contributions in the first 5 days of April, which would be in your previous tax year, but in your new accounting period, or do you make it before? And again, the calculations of company tax, do you make it because of this 5-day difference between the often many company year ends and the tax year end? Some people want to make it in the new chargeable accounting period starting on the 1st of April, but before the tax year end. And on that basis, you need to look at, well, which days can I do this? Do I need to go into a bank to make a sort of a large transfer? When is Easter, etc., etc. on that basis? But important, I've used that myself in order to make sure that my deduction from company tax was in the new chargeable accounting period because my profits were going to be greater, but I was using up the old reliefs because I was doing it in the previous tax year, and I was doing it against the previous tax year taxable income. Any questions on that? Does that make sense? I think, Joey, that the main point would be that the rental income definitely, that would trigger it. The rental income needs to go in to it. I would not sure about the partnership element, whether you declare that as well. I think you just declare the rental income, but I will check on that at some point. And if you send me an email, I will endeavour to get back to you on that, although it is very busy at the moment. So end of year tax planning for businesses. So what I'm looking at there is the end of year planning, the income expenses, allowances, and elections. So what I'm looking at is the questions. Have we claimed all legitimate expenses and deductions? Now, here's an interesting one. If anyone has a violently different view, please let me know. So I am not doing this broadcast from outer space. I'm doing it from a room in my house, which I use for working in. And on that basis, I don't use this room solely for working. That would be very bad for PPR. I have a sofa in here. I have a TV that I use from time to time. And the kids have soft toys here. So it does get used for other things, albeit probably 80% of the time for work. Anyway, I'm sitting in this room. It has a radiator, which is or has been on for part of today because it was quite frosty. And the question would be, on that basis is what proportion of energy costs can I use? And you might think, oh, well, it's 24-hour day. Let's say Jeremy's working 8 hours a day, a bit longer in the budget period, so he can claim, I know, about a third of the heating costs. But I might argue, well, actually, um, during the period I'm sleeping, I don't have the central heating on, so I'm having it primarily when I'm working or a little bit in terms of non-working time. So the proportion I can claim on those utilities should be greater to reflect that I'm actually using more of the utilities when I'm working and less of them when I am not. If anyone has a different view, let me know. And the other element in terms of expenses that I would look at would be, for example, and this is for a business, is that I have locked cabinets for client files in different rooms, tax publications in different rooms. So if I have meetings with clients, they're not in my study area. So can I claim smaller proportions where there's the business use in other parts of the house? So tax reliefs. Obviously, there are different tax reliefs. For example, a lot of people claimed in the transition from the tax year basis, from the current year basis to tax year basis for sole traders, they will have claimed overlap relief, which was the relief relating to the profits that were taxed twice or three times at the beginning of their business. Tax allowances which are available, TAPAS, the trading allowance, the rental allowance, the rent a room allowance, and all the others which could be done. In terms of potentially capital allowances, and of course, losses brought forward, can they be claimed? And again, the earlier you embark on that, the more likely you are to get a satisfactory, indeed an optimum result on that basis. There are questions. I got asked a question about a landlord who was redeveloping a cottage that was in terrible condition with a view to renting it out. Was this capital expenditure or revenue? And I said, well, even if parts could be claimed as revenue, it's all part of a capital project to bring this cottage back into use. So it would all be capital, which I don't think they were overly happy about. But the point I made was if they sell it in the future, keep a record of the expenditure because that would reduce any capital gains tax at CGT rates on that basis. So again, even disallowed expenditure can come back into use, particularly if it is a capital element. And then, of course, capital allowances. What is the best way? Maybe you want to generate a profit and you're going to disclaim capital allowances for that year or claim them only in the pool rather than in full expensing. Do you claim AIA or full expensing? If you get the choice, you'd probably do annual investment allowance rather than full expensing because of the clawback provisions on full expensing. There may be second-hand assets, which you can only claim on AIA. And of course, cars, which you can only pool on that basis. So again, getting through those capital allowances is really quite important on that basis. Other elements, should you consider changing your counting date in terms of it may be beneficial? Maybe you want to actually make it, the tax year end the same as your accounting date, or the accounting date the same as the tax year end, so that you don't have this apportionment between two accounting periods in order to arrive at the tax liability. How many family members are in the business and what are they doing? And could you give them shares? What are you paying them? And so on. You might want to crystallize gains, particularly if you've got losses in the year so that you can use them in the same year. Pay a dividend, we talked about that, or indeed paying salary. Maybe entrepreneurs perish the thought, taking out more money than they declared in the business. And instead of having an overdrawn director's loan account, maybe they should pay salary to clear that amount. In terms of the accounts, are you on a cash or accrual basis? Now, in certain ways, technology has made it easier because I can go to my NatWest account, and assuming I've been good, which I hope I have, of keeping my business dealings separate from my personal dealings. So no coming out with the business card for a dinner on Saturday night on that basis. And if I've kept them clean, then all I need to do is download my NatWest account and business account, and that's going to give me at least the starting point for my accounts each year. So again, decent processes and procedures, keeping the personal separate from the business is incredibly important. It's a great start. What I don't want to find is I'm having to constantly switch between one and the other. Of course, mistakes can be made. You might pull out the wrong card at the wrong time, but you want to keep those adjustments as small as possible. In terms of cash basis, income recognition on receipt, so you don't need a bad debt adjustment, and easier capital expenditure rules, except on cars and land. Cash basis up to 150k, then can continue until you get to a £300,000 turnover on that basis. In terms of the marginal relief, where profits are between the low and the upper rate, taxable 25% minus the marginal relief, but it's all taxable at 25%. You then take off the marginal relief, and the closer you get to 250,000, the less marginal relief you get. So if you're at 50,000 and £500, most of the effective tax rate, most of the marginal relief is claimable, and your effective tax rate will come down to just over 19%. Whereas if you have £240,000 of profits, the marginal relief is incredibly little. Actually, probably costs you more in calculating it in professional fees than the value of it, and therefore on that basis, actually your effective tax rate is very close to 25%. You then need to think about the augmented profits on that example. So taxable profit plus exempt distributions received, which are not excluded. Excluded distributions are from 51% group companies or from quasi-subsidiary trading companies or parent, mainly 90% of trading subsidiaries. So quasi-subsidiaries owned by a consortium where the recipient of dividend owns less than 75%, and no arrangements by which it could become a 75% subsidiary. Let's take an example here. So ABC Limited has chargeable profits of 190,000 and no dividend income. So taxable profit and augmented profit are both 190,000. Augmented profit is between the lower limit of 50,000, the upper limit of 250,000, so marginal relief applies. Tax at 25% on 190,000 is 47,500 minus 3/200 times, as you can see, the marginal rate is based on £3,000 of small profits relief over the £200,000, which is the band between 50,000 and 250,000. And what it's saying is that this is marginal relief. But the higher your augmented profits are, the lower the relief you'll get, which is £900. That could also be calculated, and that's important in terms of tax planning. Of the first 50,000, taxable at 19%, which is £9,500. The remaining 140,000 is taxable at an effective marginal rate of 26.5%, giving you 46,600. And that works if your augmented profits and your chargeable profits are the same, i.e. there are no group no dividend income. And the important point from a tax planning point of view is that if I took 50,000 from a profit of 100,000 and put it into my pension, the company tax saving is at 26.5%. I would be saving £13,250 that basis. If I do have non-group dividend income coming in, and if say the chargeable that doesn't affect the chargeable profits, still got 190,000 of chargeable profits. On that basis, again, the marginal reef, so 25% on 190,000. But note that the dividend income reduces my relief from £900 to £118.75 because I'm that much closer to the 250,000 upper limit. And on that basis, you wouldn't be able to do the ready reckoner because actually your first 50,000 would be chargeable at 19%, and the ready reckoner would say the next 140,000 would be taxable at effectively 27.058%. So the more dividend income you have that doesn't qualify always as exempt and would be included in augmented profits, albeit not in chargeable profits, actually increases the rate of charge on chargeable profits to effectively 27% on that basis. And on that basis, again, paying a pension to reduce the amount in the marginal rate would save you more money, or indeed bringing expenditure forward. If I have a group of companies, here I need to think about the fact if I've got 9 subsidiaries, 3 are non-UK resident trading companies, 2 are dormant, and 4 are UK resident companies. If I bring them into account on that basis, what I look at is, well, I ignore the top company because all that does is its function is to receive dividends. It incurs no expenditure, has no assets apart from its shareholdings in subsidiaries. The 4 resident trading companies have the following taxable profits: JKL at 140,000, MNO at 24,450, PQR at 6,420, and STU at 78,110. None of the 4 subsidiaries receives any dividend income. What you would do there is the upper limit and lower limit needs to be divided by the number of associated companies, and you ignore the dormant companies and the top company, so it's all divided by 7. What you then have with the lower and upper limit being reduced is that you've got 2 companies, STU and JKL, above the revised upper limit, so all at 25%. PQR is below the 7143, which is the lower limit, and therefore all taxed at 19%. And MNO is in the marginal rate of tax, which means all taxed at 25% and a small amount of relief given to them. The issue that you've got about that is, in terms of tax planning, what you would probably prefer is to increase the amount taxable at 19% under PQR. Remember, it's a hybrid system in that every company is responsible for its own tax return, but its tax liability could be affected by other elements within the group. And you would take that income from MNO, which is charged at the marginal rate of 26.5% effectively, and try and give more to PQR, which would then be that extra income would only be taxed at 19%. So you take it from 26.5% chargeable in MNO to PQR only chargeable at 19%. Something in the chat box, maybe a question. Yes, that's also true, David. Yes, non-exempt dividends may also push the company into the payment by installment system. So do watch that, that point at 1.5 million. Now, tax planning. Do I need all these subsidiaries? Is there a point? Have I been collecting subsidiaries a bit like collecting old books? Do I need them all? My wife would certainly tell me I don't need all the books I have here, um, and would like me to get rid of more books and papers and so on. And companies, it's the same way. I remember working for an asset manager and the CEO saying, every month we would produce a family tree of companies. And he kept on saying, we don't need all these companies. They're costing a lot of money. And we went with a sort of a program of reducing the number of companies and getting them struck off or liquidated at a program, in a program. And therefore, reducing the number of associated companies is probably a good idea. In terms of other elements that you would think about would be, so let's look at remuneration. You would think about accelerating bonuses, looking at salary sacrifice, and of course, checking employment allowance eligibility. Any questions on that? If not, just want to talk a little bit about the national living wage and national minimum wage. They're going up substantially. Again, I mean, we're talking about 8.5% increase for 18 to 20-year-olds. Why? Every cloud has a silver lining on this basis for the employer, because they can justify higher salaries to family members on that basis if they want to use up the personal allowance. And as I say, in terms of the planning, you could be thinking about, well, if you want to, there are a number of elements you might think about. Accelerating income, trying to get, if you're on a cash basis, get your supplies to pay before the end of your accounting date, if you can. Deferring expenses, possibly. If you're looking to increase your profits or create a profit, maybe you want a profit because you've had losses in previous years and you're a bit worried about whether you can use those losses. Disclaiming allowances, particularly capital allowances, you can bank them for another time, or paying members of the family. And you need to think about the balance, because obviously you could be looking at deferring income, accelerating expenses, deciding that actually there's something you want to do in the next 3 months and you want to spend the money now on that, or can contract yourself to spend the money because you think your profit's going to be too high. For example, let's say you need another laptop or something on which you'll get full relief in 1 year. On that basis, plant and machinery, you might decide to spend on that before your accounting period ends. And again, paying members of the family, looking at that basis of what is justifiable and what you want to pay. Let's look at expenses to claim or not to claim. So some of them will be based on the actual figures on that basis, and some may be based on flat rate. So flat rate alternatives, the trading and property one £4,000 cannot be used for where you are doing where it is, where you are doing transactions with a close company of yours. You can't then use the tapas on that basis, nor the rent to room relief. Working from home, £6 per week, but going April 2026 for a claim by the employee, but the employer can still pay somebody £6 a week for working from home. And remember, car at 45p per mile, first 10,000 miles, or potentially the business proportion, if it is higher, of the costs. And you'd need to think about that carefully. Question. Another question's come in. Please indicate how work from home can be deducted other than the £6. For example, a house has 4 rooms and 1 room is used for work. Can we take the rental mortgage and claim a quarter. Oh, well, the essence would be is, are you using that room solely for business? In which case you might fall into the trap of finding your PPR is then affected, that you can't claim fully for PPR. So that's going to be one element that you're going to have to think about. Potentially in terms of the rent, that should be okay. And the same with the utilities, although I have an argument that you would be able to claim more for the utilities on that basis. The question would be, as I say, in terms of this, remember that from April 2026, an employee cannot put it in their tax return as a deductible expense, but the employer can still make a payment equivalent to the expenses, either at £6 a week or if justified for a higher figure on that basis. I did have an interesting position when I worked for a company that was based in Australia. We had an interesting argument that each and every office holder would have had to undertake that expenditure, because you weren't going to be in the office at sort of 11:30 at night or 6 in the morning at Australian times in order to do that. So it is a little more complex than just doing it a quarter. And I think it often bears a reward to actually analyze that expenditure quite carefully and make a reasoned proposal based on that for the employer to reimburse it, particularly from April 2026. If there is a payment for the employee's expense to work from home, is this also taxable? So Sean's asked, well, if all it does is that it reflects the employee's expenses to working from home, then it should be sort of income in, expenses out, and it would be the same if paid by the employer. Or you can do the £6, again, tax-free. The element would be is this a question of choice? Or so if it is choice, then arguments are that you wouldn't get the reimbursement of the normal elements. So I'd get maybe I won't get the utilities and the home on that basis if it's just a choice, and I could stroll into the office. If, however, everybody, and it's my contract, all people work from home and there's no choice in the matter, then you're on much stronger grounds to claim it. I hope that answers the question, Sean. So if I make the payment, you've got to understand, why am I making the payment? Is it really by reason of employment, or is it just a choice? And, are there other people who've chosen to work in the office, and therefore that's why, it's just a personal choice, in which case probably the telephone costs would be all right, but others would not. Now, the other element would be is that if my employer provides me with a computer and printer and other elements, the provision of that would also be tax-free on that basis. Somebody's asked me about, I know, garden homes. So doing the home, like a sort of a shed at the bottom of the garden, or something that looks much better than a shed. The issue with that, again, would be, if the company pays for it, is that is that going to affect my business rates, for example? If it is company only use, would it affect my PPR, possibly if it's used exclusively for business? Do other members of the company have the right to access the area of the office? Is it properly ergonomically designed? All of those elements make this quite a difficult issue to deal with. So in principle, the company could provide you with a pod for it at the back of the garden, but don't think you're totally out of the tax woods. You could be in issues, how much is it used for business? And secondly, you would look at the situation in terms of the not just the business rates, but the PPR relief as well. Employment expenses, as I say, removing the ability of employees to claim deduction of non-reimbursed home working expenses. Notice non-reimbursement of home working expenses from the 6th of April 2026. Reimbursed expenses will still be tax and NIC free. And interestingly, the reimbursement of eye tests, home working equipment, and flu vaccination costs will be tax and NIC free from the 6th of April 2026, but not COVID jabs. Quite interesting on that basis. And just to reinforce that the working from home, the relief for £6 working from home disappears unless paid by the employer. And you're looking at the expenses rules in general in terms of getting a deduction. Let's look at the Q&As I've had here. Put in place a non-exclusive rental agreement with the owner-managed companies, then claim the rental expenses. Yes, I think that would work. The issue would then be is I need to declare the rent that I'm charging. It needs to be at a market value element, particularly scrutinized if I'm doing it with an owner-managed business, and claim the rental expenses against that. That would be something I can do. The element that I would always think about is, yes, rent is an advantage because it's deductible to the company and the individual does not pay national insurance on that rent. But of course, from, I think it's 2028, rental income will be chargeable at 22 or 42 or 47%, i.e. 2% more than ordinary income. If the pod is a temporary, so that answers that question. If the pod is a temporary structure and can be easily removed and put in a different location, wouldn't that work better for tax relief on the company and for the staff? Maybe. Question about, what is the basis of the access to the garden? How can you remove it? What is the link to utilities? So presumably it'll be hooked up to utilities. And can it actually really be moved? I would point to a different one in terms of capital allowances. When we were talking about, there were pods for, I think it was some nature element, where the capital allowances were allowed for a very basic pod in which the children were staying, but not for the adults who had a less basic pod. So I think I would look at that case, which looks at pods. You can probably look it up, Google it, or use maybe the Tolley's library on that basis, if you've got a subscription to Tolley's. And there's a classic case about the allowances and whether they could be claimed. And they couldn't be claimed when it was a very nice structure with lots of utilities connected, whereas it could be claimed for the kids who had a very basic structure. So that's the sort of element I'd look at. So in terms of that, you're going to look at things like rent, utilities, telephone, internet, insurance, particularly if you've got extra insurance because you're carrying on a business there, repairs and maintenance, staff costs, and of course, advertising elements that you might want to look at. And of course, with advertising, let's say you start a campaign or you decide to update matters in terms of the advertising, that you might decide before or end of your accounting period. Other elements you think about: cars and vans, travel, office and administration, accountancy fees, legal, bank charges and interest. Now with the legal, it depends on what it relates to. If it relates to purchasing a property, that will almost certainly be capital. Whereas if the legal expense relates to, say, a trade dispute, that will be normally revenue. and fees, professional subscriptions and training. Always look at the professional, the training, does it relate to the actual activities? There's less issues where the employer pays it than if the employee is seeking reimbursement. Where an employee seeks reimbursement, that is generally more difficult to claim. And there's a general trend with that, working from home, training, and other elements, more difficult to claim a reimbursement, to claim, sorry, a tax deduction on your tax return. Much easier when the employer pays for it to be tax-free in the first place. And in terms of capital versus revenue, always look at the difference between the two, but also look for trailing expenses on that basis. Well, let's take, oh no, I'll do the last bits here. Capital allowances, watch for your writing down allowance. Remember, it's going down from 18 to 14% on plant and machinery from the 6th of April 2026 or the 1st of April, depending on whether it's a company or personal structure. AIA, the £1,000,000, use it or lose it. The special deductions you can get for energy saving equipment, and the structures and buildings allowance, generally 3%, or it's 10% in investment zones and free ports, and therefore the actual structure itself. Important to understand in terms of deferring or spending, looking at the capital position, the revenue expenditure, what your cash position is, and what accruals basis in terms of deciding the timing of expenditure, particularly near the end of your accounting period. So I'm going to move on to remuneration strategy, but I think because we had a delayed start, I'm going to take only a 5-minute break now, 5-minute comfort break. So in the last part of this course, I'm going to look at remuneration strategy a little bit more in the era of tax rises. And one of the elements that you might want to think about, and clients will look at, is to incorporate or not post the budget. And the element I would mention very clearly on this basis is that 20 years ago, or slightly over, when we had a 0% corporation tax rate, starter rate of 0%, introduced by Gordon Brown, and we had lower dividend rates and relatively high national insurance rates, it was almost certainly, it was a bit of a no-brainer: incorporate, pay yourself a salary up to the personal allowance, and then pay yourself a div or something like that. The position is much murkier now on that basis. Why is it murkier? Well, it's murkier on the basis that since then, corporation tax rates have gone up, number one. Number two, or back up again, number two, dividend rates have gone up. There's this employment allowance of £10,500 against class one national insurance. So on all those bases, if you think taking dividends becomes less beneficial than it used to be. So you need to go through all the figures on that basis in order to work out what to do. What do I mean by that? Well, the issue is that there are a lot of moving parts, and most of the moving parts have gone against company structures. The higher CT rate, obviously, because dividends are not deductible against corporation tax, whereas salary is. The 10,500 national insurance allowance, which reduces potentially employer, and I say particularly important for the smaller business. And therefore, on that basis, you particularly with the self-employed national insurance, going down to 6%, class 4 NI, which is the lowest it's ever been. That is a major issue in terms of, on that basis, 6% plays 15%, and that 6% is only up to the upper earnings limit. That is a major advantage for this self-employed. So, as I say, it looks at a number of elements on that basis. And if you look at that, the employment allowance at £10,500, there's no cliff edge at £100,000 secondary and national insurance, which you used to have, but you need 2 employees above the threshold, the secondary threshold for national insurance. Let's say there are a lot of moving parts. The employment allowance, 10,500. The dividend rate for this year, 8.75, 33.75, and 39.35%. As I said, for next year, going up to 10.75, 35.75%, and the top rate remaining at 39.35%, and the CT rates of 25, 19, and 26.5%. These figures are, however, updated for the new regime with the higher rate of tax on dividends. And what you can see on that basis is, with the exception of at around £60,000 of profits, the sole trader does better in every other category in terms of net take-home pay. And that's before thinking about the fees that you will need to pay through running a company. And as the profits get bigger, so generally the differential gets bigger. So then when we look at £240,000 worth of profits, you're actually at a differential of around £16,000. So the issue that comes up, and that is even whether you pay up to the lower earnings limit of national insurance, or the personal allowance and the getting the employment allowance, even with those advantages, generally speaking, the sole trader is in a better position. And that might inform, do I incorporate or not? The one element which is a variable that every client would be different on is, to what extent am I using the profits from the company for my own personal use? Do I need to draw a salary? Do I need money? On that basis, if I don't need the money and I'm stacking up the cash in what is a relatively lowly taxed company compared to personal rates, then on that basis, if I'm stacking the cash in the company or capital, or I'm reinvesting it in new investments, then potentially you get a different answer. And that's why there is no one size fits all answer to this. You really do need to look at a client at all their considerations. Let's look at a few examples on that basis. So if I look at that in terms of example 1 here, what I'm looking at is profit before any direct withdrawals. And this is this year. Slightly changed for next year. Director takes 12,570 of salary and post CT profits as dividends, and assume no employment allowance available, and the director's other income is negligible. And remember that the dividend allowance is only a relatively small figure of £500. On that basis, salary of 12,570, post CT profits as dividends. Remember that you're being charged at 15% on the NI, so that's £1,136. Total deductible for CT for companies 12,570 plus what I'm taking as salary, plus the 1,136 of employees NIC going up to £13,706. CT payable by the company is 30,000 minus 13,706 at 19% is £3,096. Profits available for distribution, £13,198. If I think about the income tax on those dividends, 13,198 minus 500 at 8.75% is 1,111. The cash in hand on that basis is only 24,657. Overall tax cost, adding the employees NI, the CT, and the income tax is 5,343. What if the director was self-employed instead? Well, you can see it's much simpler. There's only one calculation to do, and that obviously has a knock-on effect on fees. And what you can see is that they have some Class 4 NICs at 6%. Remember, the threshold for Class 4 is the same as for tax on that basis, and that's the only charge you pay at 26%. And that will give you cash in hand of £25,468, which, of course, is around £800 greater than for the director. And of course, next year, with NI going up by another, dividend tax, not NI, dividend tax going up by another 2%, that is going to affect matters further. In example 2, profit before any direct withdrawals of 80,000, director takes 12,570 of salary and pays CT profits as dividends. And again, no employment allowance available, and the director's other income is negligible. Here, you can see the number of calculations you have to do. Class 1, employer NIC, 1136. Deductible for the company is still the same, 13,706. The taxable profit now is 66,294. What you find on that is, of course, you're above the small profits rate of 19,000 and into the marginal rate at 26.5%, which gives you a charge of £13,818 corporate tax. You know, substantial increase, partly because profits are increased, but you're also entering that 26.5% band. And the profits available for distribution, you take off the salary I've taken, the national insurance that has been paid on it by the employer, and also the corporation tax, leaving me 52,476. Income tax on those dividends. So remember, that is going to go up by 2% next year in each category. So on this year's basis would be 8,242. Cash in hand, 56,804. And the overall tax cost with the three components, employers NIC, corporation tax, and the tax on the dividends is 23,196. What if the director was self-employed? What you would be looking at there would be a much lower figure. So a band at 26, a band at 42%. So therefore, on that basis, and remember that is then salary, not dividends, which will be important, as I say, for next year. And you end up with 56,804. It would have been as a director, but you boost it by £900 if you were self-employed. And that's partly also due to the fact, there was this steep reduction in Class 4 NIC, and then you get the upper earnings limit beyond which is only at 2%, which gives the self-employed a big advantage. In example 3, I'm looking at the same issues, but at 150,000 on that basis, and that gets more complex indeed. And here you're doing something that you might not do, which is you're going to distribute all the profits again. Remember, the CT's gone up more because you've got 86,000 now at the 26.5% rate. When you take off the same element of salary, employees NI, and the very big CT bill, you end up at 103,926. Assume it's fully distributed on that basis. And one of the elements is you're now well above the 100,000 threshold. So your salary is not fully tax free. Basically, only 4,322 of your personal allowance remains because you've knocked out, 16,496 divided by 2. So the amount above 100,000 divided by 2 will be taken off your personal allowance. So you end up with £8,248 at 20%, 1650. And the income tax on the dividends is substantial at 27,668. If you were the cash in hand is £87,178, and the overall tax cost is £62,822. What if the director was self-employed? Well, you've got a huge advantage of you're just at 20, 40, and 45% in terms of the tax. The Class 4 NIC first 12,570 at nil, 37,700 at 6%, and the balance at 2%. So although, because you are way above the additional rate threshold, you're going to have some at 45%, but also you've lost your personal allowance. It's all going to be taxable. But even with that, when you add the two together, there is a £5,000 differential between the director getting 87,000 and the self-employed person getting 92,000, which may mean that you will want to change the way that people are remunerated. Maybe you're going to not operate through a company but self-employed again. And note, with the 2% increase on divvy taxes, you're going to end up with a significantly bigger gap on that basis. Final thoughts. The position is slightly more nuanced than this. If the owner eventually extracts the extra post-tax profit from the CT savings dividends, then there's extra income tax to pay at 33.75%. If they leave it, which will go up to 35.75% next year. If they leave it in the company until liquidation, then there'll be an extra 10% or 24% CGT pay. Yes, partnerships may become more popular with the added advantage of making tax difficult. I think that that's a fair comment, particularly if the government shies away further again and does not put extra tax on LLPs, which it was looking to do. Partnerships will become potentially more popular in terms of this. And of course, the compliance costs of partnerships would be probably less on that basis. Any other questions? No? Maybe I also need to look at losses, because obviously in terms of a self-employed, easier to use losses. Your options are sideways loss relief, carry back 1 year, or carry forward against the same trade. And that's the standard element. So that's one element in terms of the sooner you get your figures done, the easier it is to determine how you're going to use those losses. In terms of sideways loss relief in the year of the loss, previous year against other income on that basis, or cannot be used limited to preserve personal allowances. So you can't just limit the loss relief and say, I want to have the first 12,570 taxable so that I can use my personal allowance and maintain my losses. It is an all or nothing basis. Also consider, if you start an unincorporated business, for the first 4 years, if you make losses, you can carry back against the last 3 years before you started the business. And on that basis, you could take that against your salaried income you had completely unconnected. Let's say you had a salary, then you decided to give it up and start a new business. First 4 years of losses you can carry back against the last 3 years before you started the business. If you had substantial salary then and paid underpay as you were, and you could claim that money back while the taxable income. So that's a significant advantage of a sole trader. We talked about capital allowances. Then, in terms of capital planning, we could talk about the business asset disposal relief. Of course, as I said, it's become much less valuable. Was worth up to £1 million when it was, 10% differential on £10 million. Even at one point, it was between 28% and 10%. So it was 18%. It was worth 1.8 million. It isn't what it was. It's worth up to £100,000 per person this year. Lifetime limit, and if you wait till next year, it's only worth 60,000. But there is, as I indicated, holdover relief potentially on assets which are transferred, and also reinvestment relief which could be available. In terms of whether you want to crystallize things or not, that's a different matter. In terms of the extension of 1 million AIA indefinitely, that is worthwhile for companies. The availability of full expensing and the 50% SR allowance helps larger companies. Other capital allowance changes: general decommissioning allowances in extractive industries can include expenditure in anticipation of approval of abandonment program. And long funding leases can elect to ignore the anti-avoidance rule where a lease is extended because of rent concession by the lessor due to COVID-19, although that is less likely to happen now. Dividends this year, £500 dividend nil rate band, basic rate at 8.75%. That's what you pay on dividends, but next year going up to 10.75%. In terms of partnerships, um, one of the elements, as was pointed out by a participant here, they could become more popular based on the tax advantages, but also not needing to do making tax difficult for the moment. Partnership allocation of income, expenses, and interest on that basis. So let's have a look at the questions. Any examples that show a more realistic example of limited company director taking advantage of things sole trader can't get? Pension direct from the company scheme restricting income in year 50k. No, I mean, Paul, you could do any multiplicity of elements, and that's why I'm saying it's a good starting point. It's not a finishing point, and I could spend the whole course talking about those sort of elements. Yes, the money going into the pension is a consideration. Restricting income, I've already talked about there, which you can't do really as a sole trader. It's based on your profits and on a cash basis when people pay you, on an accrued basis when you bill for stuff. Liquidation route. Sorry, yeah, Paul, I have changed it. So there would be no BADR relief, but you could get a multiplicity of other reliefs, which effectively is EOT, potentially at 0% next year, an effective rate of 12% on an EOT, employee ownership trust. You could get 14% BADR, 18% BADR, or basic rate is now at 18%, or you'd be at 24%. Hope that answers the question. It's a bit difficult to keep up with all the different budget changes. But yes, you are talking about all sorts of different rates which are available on that basis. So it was 10 for last year. So if you're doing the tax return for last year, you had 10 for basic rate is now gone up. So it was 10, now going up to 14%, then 18% with BADR. And the top rate is 24%. If shares are gifted with market value in excess of 1 million, is the 1 million tax free and can excess be claimed as holdover relief? No, that's definitely not right. On the basis that, yes, you could look at the IHT, but the concern would be you haven't got £1 million threshold for capital gains tax. You need to look at the whole gain. All that you might get would be £3,000 annual exemption. So therefore, you've got to look at holdover relief on the whole amount on that basis. So the issue is going to be is, let's assume you started this business and now that parcel of shares is worth £1 million. You might be looking at business property relief, where you would get £1 million relief potentially at 100%. But you're not getting capital gains tax relief on that basis. And there you've got to look at the holdover position. This also becomes more complex because, of course, there are different valuations for minority shareholdings and majority shareholdings, indeed, in between IHT and capital gains tax. Capital gains tax looks at the market value between connected parties, whereas IHT looks at the reduction in the estate of the donor. And of course, you think to yourself, well, why aren't they the same? Well, if you're a minority interest, actually your stake is worth less proportionately to net asset value. I talked about this fact that if you have a £10 million company, I gave 10% away, that is not worth 10% of the net asset value unless there's a general offer for the shares. You get a discount of up to 80%. So from a capital gains tax point of view and an income tax point of view, that would probably be only worth something like £200,000. But if that 10% took me from a majority to a minority stake, that would reduce my estate for IHT purposes more than actually the 10% value of the shares, because I've now gone from majority to minority. And therefore, the value for IHT purposes would be a lot greater than the £1 million. If I'm moving from majority to minority, you look at the value of the estate that's remaining, look at the value of it beforehand, and you could end up with a figure that is greater than the net asset value of those net asset value of those shares. But the other element in terms of CGT is you have to do holdover relief on the lot to avoid a CGT charge. A partnership, you're going to look at the income, expenses, and interest on that basis. And important, that's one of the areas that you can shift between different members of the partnership pretty quickly. It's a fairly easy process to do so. And therefore, something that you probably want to think about in the course of the partnership year. Look briefly at VAT, and with VAT, one of the elements you would think about would be, can I claim the flat rate? Is my turnover below £150,000? Would the flat rate be better? And that would depend on the business you're in, and therefore the rate percentage that you have to pay over to HMRC. The less of the turnover that you need to pay over to HMRC, the more likely it is that the flat rate will be better than just doing the default basis, which is the taxable turnover and the VAT on that, output tax, versus your expenses and the input VAT on that. If you're above £150,000, then you have to do the actual basis. But again, important in terms of planning on that basis. And the other element with VAT is if there is an exceptional reason which you can foresee where you will go over the VAT registration limit and you will fall away very quickly from it. If you apply for it not to apply early enough, i.e. before that happens, before registration becomes compulsory, then potentially you can avoid VAT altogether. This does not work very well always. There's a case of a marriage guidance counsellor who saw her income shoot up because of COVID, um, and but applied far too late for her to avoid registration, and that was extremely costly for her. Going to move on to the use of directors' loan accounts. We've got a relatively short period left. If no profits, then no dividends can be paid, but our directors still need money to live on. So consider the write-off of a DLA, treated as dividend for income tax purposes, but also NIC payable potentially. Write-off may be allowed if pressed for recognition that write-off is earnings for both tax and NIC purposes is prevented from being taxed as earnings by employer. May face a wholly and exclusively challenge, but could argue write-off allows directors to focus their energies on the company and trying to make a profit rather than worrying about owing the company money. I mean, it's a bit more difficult than that used to be. But director's loan account in credit allows you to pay dividends, potentially utilizing the personal savings allowance. And indeed, there's no national insurance. And potentially, if you're paying very little in salary and other taxable amounts, you could use the £5,000 savings rate on that basis. Possible use of a SIP to purchase commercial property in the future, that would save national insurance, but do consider the corporate tax liability. And in terms of loans, benefits and rents, loans may be useful for short-term cash requirements, but ensure repayment before the 9 months after the year end to avoid the 33.75% charge this year, going up to 35.75% next year. And the important element on that is it's linked to the higher rate tax rate for dividends and therefore going up to 35.75%. May be possible to get corporation tax relief on the loan waiver, i.e. a tax deductible element. No benefit if loans to each employee are less than £10,000 at all times in the year. In terms of benefit in kind, consider the capital allowance rules and car benefits for green cars. Also non-taxable benefits such as childcare, on-site childcare, parking mobiles, and the other elements that we talked about, home in office, office in home equipment, annual medical checks and those sort of elements. Rent on personally owned assets, own a trading property outside the company to avoid double tax charge and NIC on rent paid for use, and consider VAT implications such as option for tax and the impact on CGT release of charging rent, particularly business asset disposal relief. In terms of key management remuneration, consider incentive-based cash bonus schemes, simple but commercially attractive, and shares or options EMI take advantage of possible depressed share values to issue shares or options. In terms of cheap loans, no charge loan, or if the loan does not exceed, it's not £5,000, it should be, I don't know why, it should be £10,000 on that basis, may be attractive for employee and helps retain them. And then benefit salary sacrifice, having regard to the restrictions there, you can reduce the employer's NIC and give tax and cost savings from the bulk purchase. And then finally, what I'm going to look at would be, I'm looking at tax advantage schemes. I talked a bit about them for owner managers. So why shares? Obviously the cost, the incentive, the funding, and the alignment of interest. And where a lot of tax reliefs have been reduced, these have generally been increased. I talked about that in the budget for those who were there with the EMI scheme. But let's take an example. So on this basis, what we're looking at is what you'd be looking at is Kirsty's granted 10,000 of options, 6th of April 2022, when the value of the shares was £1. This was the strike price. The vesting period was 3 years, and the options needed to be exercised within 10 years of the grant. On the 6th of February 2025, the share price was 90p and therefore underwater. Kirsty did not exercise her options at that point. On the 6th of February 2026, the share price has risen to £2 and therefore Kirsty exercised her option to purchase the shares. She made a gain of 10,000. Exercise price £2 times 10,000, 20,000. Strike price of £10,000. If I look at the tax advantage, Kirsty makes a paper gain of £10,000. This becomes a capital gain when she sells the shares. She has no other gains in the tax year. She can sell shares with a CGT of about 1,400, depending on whether she has an annual exemption and to what extent she has that. No national insurance for either the employer or the employee. Then non-tax advantage, Kirsty makes a paper gain of 10,000. Assuming she is a higher rate taxpayer, she will pay 4,200 in tax and NI, leaving 5,800 in proceeds, and the company will pay 15% NI, £1,500. So considerably better to have a tax advantage scheme. And with employers' NIC having gone up, that gets even better. What if Kirsty was granted £60,000 worth of options, and that is the new limit for CSOPs? Grant price £1, exercise price £5, gain of £240,000. Non-tax advantage, you'd have tax at 45%, 108k. Tax advantage to assume CGT at the higher rate on everything, and also I've not given her the £3,000 annual exemption. You end up with £57,600. NI at 2% would be £4,800 on that basis. And also you'd have employer NI on that basis at 15% as well. So on that basis, a tax advantage scheme is considerably better. What occasions would you not use a tax advantage scheme? Well, flexibility. You don't have to comply with the rules there. International alignment, above advantaged limits, tax advantage limits. Although with EMI, the limit is £250,000. If you can get within that, and also they've extended, you can now from next year get companies of 120 million in terms of gross assets and can be within EMI. And obviously there is less compliance requirements with the non-tax advantage scheme. In terms of employment-related securities, something we talked about, that applies to securities or an interest in securities acquired by a person where the right or opportunity to acquire the securities or an interest is available by reason of an employment of that or any other in person. And employment includes former or prospective employment. But as I said, in terms of for UK tax purposes, one of the big advantages is if you have an unquoted share, you're going to look at that value of the share and say, what do I get for it? I may only have a minority stake, so the voting isn't terribly useful. Maybe there's no track record of dividends, and it's unquoted shares. I may not be able to trade them very easily. So I get a discount potentially, which could be very big. And then, up to 75, 80%. But of course, if somebody then comes with an offer for the shares at some point later on, I will sell the shares just like anybody else and the discount disappears. So let's say I was given £1 million worth of shares based on net asset value. So that's 10 million, 10% of the shares, £1 million. I get an 80% discount down to 200,000. Then somebody comes a year or so later, wants to buy the shares, buy everybody's shares. I then sell based on 10% of net asset value. If they make an offer of £10 million, I end up selling the shares for £1 million. And the gain, the difference between the £200,000 I paid for them and the £1 million I get for it, would be subject to capital gains tax only. This assumes, of course, that this buyer was not around or there was no prospect of it when I actually got the shares. And that could be extremely useful in that way. If I look at shares versus options, shares are a share of the company, and an option is a right to buy a share in the company at a predetermined price. Shares give me a right to dividends, options don't. Is my money at risk? Yes, if the share price goes down. With an option, no, you're not forced to purchase the shares on that basis. Shares get voting rights and options don't. And if I look at the elements, the type of shares I've talked about, SIP, share incentive plans, SAYE less so because it's generally very large companies. Company share option plans, that is for the options, and that is more generally usable than the EMI. Although the EMI has become interesting, there's a limit on the size of the company now at 30 million. What is proposed is that limit will go up to 120 million pounds. But let's have a look at the use of a SIP in a small private company. So in a small private company, I talked about the IHT advantages, but what if the company establishes a qualifying share incentive plan and invites all qualifying employees to subscribe for, say, £1,800 of fully paid up non-voting B shares out of pre-tax bonus to be held on their behalf by the SIP trustees as partnership shares. The unrestricted market value of the B shares agreed with HMRC to be, say, at a 75% discount to the pro rata value of an ordinary share. Under the Articles of Association, when a participant leaves for any reason at any time before the company sold, the SIP shares must be bought back for the price first paid. Let's take an example. If and when the company is sold, either after 5 years or for cash after, say, quadrupling in value, not impossible when we're talking about a company going for a float, the investment of £1,800 tax-free would produce a return of 28,800 tax-free. And you could offer 1 for 10 matching share at no extra cost, given the saving of employers' NIC, and then your gain comes up to £31,680. Let's look at the calculation for that. So if I look at the calculation there, what you can see is I've got the value of the whole company, £1 per share at, say, 720,000, 1% of shares, 7,200, discount here of 75% for lack of marketability, no dividend record, minimal voting power. So the value into the SIP is my £1,800 on that basis. Value 5 years later, the company is sold 4 times the amount for 2.88 million. My 1% share capital, no discounts and net asset value on sale, gives me £28,800 completely tax-free. If I got that matching element, the only change on that is I get an additional 720 shares on that basis. That would take me from 7,200 to 7,920. Discount 75% as before, 1,980. 5 years later, company sold for 4 times the amount, 2.88 million, and the proceeds without discount would be £31,680. All CGT, income tax free, national insurance free, and no IHT. The final elements to look at would be if the small or medium-sized companies looking at overseas expansion or transfer pricing. How is the best to structure? Is it a branch or a subsidiary? Branch is normally easier to reclaim the losses that quite often overseas entities make in their first few years. You would consider the controlled foreign company legislation where you've got a captive, say, finance or insurance company, and whether that affects your UK liabilities. And you're going to look at the residency issues of the company and the directors. Ensure that potential overseas VAT registration is considered and VAT treatment of any intercompany charges. And transfer pricing, if the company is not exempt from transfer pricing, consider the full review of pricing policy. If trade is in goods, ensure that any customs duties implications, because customs duties keep on changing, are considered on a regular basis. In terms of payments of tax, with quarterly payments, the 1.5 million threshold or the 20 million threshold, both of which are reduced for the number of associated companies you have. If the profits are near the threshold, consider additional bonus pension contributions, interest on loans, etc., to avoid the instalment rules. Remember, two companies in association and the QIP goes down to £750,000 threshold for the companies in the group. And if there's a very large, which are real-time payments in months 3, 6, 9, and 12, the original limit is 20 million if you had 5 companies in the group or associated. Remember, it also includes associated companies. That would take you down to £4 million in terms of the threshold. In terms of shareholder issues, you might insure a trading company for business asset disposal relief, maximum use of £1 million limit among family members, review the qualifying conditions for business property relief, and ensure a shareholders protection policy exists with suitable cross-option arrangement for business property relief. And in terms of tax-efficient investments, remember that the EIS and VCT schemes, although change, have been extended to 2035. With the SEIS, certainly high net worth individuals may want to consider them. People who are not averse to investing in higher risk elements. The investment limit's frozen to 5th of April 2031 for ISAs, junior ISAs, and child trust funds. So in terms of that, as I say, consider earlier investments in the tax year. There's more choice, and it does accelerate tax relief timelines for things like business property relief and indeed the CGT exemption on the investments themselves. Okay, at this point, many thanks indeed. If there are any questions, let me have a look. Only about the recording and the slides. If there are any questions, please let me know now. Otherwise, you can contact me via the K3 Hub, or there is my email address. One other question Chris had. Does the salary sacrifice pension rule change apply to OMB directors who might vary contributions and salary and dividends from year to year? I know contractual salary level. At the moment, that would appear to be out of it because they just decide to pay themselves salary. They're not sacrificing a pre-agreed salary. So as long as there is no sacrifice arrangement going on, they just decide how much to pay themselves and how much to pay in dividends. I don't think that they're affected, well, certainly not as it looks at the moment, although they may change. There's a long time till 2029. So I hope that answered that question. Other than that, no other questions. Sorry, chat box. No. Okay. Any other questions? No. Okay. On that basis, thank you very much indeed. Um, and as I say, I hope I've answered all the questions. Yeah, keep on making pension contributions. And there's nothing in the rules that stops you doing it after April 2029, except through a salary for sacrifice element, unless, of course, they change the rules. Thank you very much indeed. I'm going to sign off. Thank you. Have a great weekend.